Hi guys, the financial year 2021-2022 is coming to an end and it is the right time for all of us to get worried about taxes. So as stock market participants, there are a few things that we can do to save a lot on our tax burden. So with the tips and tricks that we're going to discuss in this video, you can save up to 50,000 rupees in your tax bill or even more. So this is Market Feed, let's get started. The first thing that you have to know about is what is your current tax bill. What is the tax on stock market investments and trading that you will probably have to pay. So if you know this topic, you can skip to this timestamp here. First, let's discuss about long-term capital gains. These are your capital gains or your profits on long-term investments. That means on equity shares that you've been holding for more than 1 year. The long-term capital gains on equity shares in India is 10% of your profits. But there is a catch here. If your profits are under 1 lakh, up to 1 lakh you do not have to pay any tax. Only the amount above 1 lakh you have to pay tax. So there is a deduction of 1 lakh in long-term capital gains. Next comes the short-term capital gains. These are the capital gains or the profits that you generate in swing trading. It is the profits that you generate in trading equity shares in the market, and this is at 15% of your profit amount. If you're doing intraday equity trades or futures and option trades, these are classified as business income and they'll be added to your current tax slab and you'll have to pay tax according to that. On all of these three type of profits, you do not have to pay any tax if your income is less than the income tax slab. And there is one other thing that you have to know about. Even if you do not have any profits in the long-term capital gains or short-term capital gains, you can file your income taxes. If you have any losses for the same, you can file your income taxes so that you can set off your current losses against any future profits. So in long-term capital gains, that is in your long-term trading, you can get up to 8 years. You can carry forward your losses up to 8 years. It is the same for short-term capital gains as well as futures and option trades. If there are any losses that you have generated in this financial year, you can carry it forward for the next 8 years. Only in intraday equity trades, you can only carry it forward for 4 years. Any losses that you have currently, you can carry it forward for 4 years. Even that I feel is really good. Now let's talk about 3 interesting concepts with which you can save your taxes right now. First is tax loss harvesting. You may have heard about it somewhere, maybe on YouTube, maybe on some article, but probably you do not know how or why you are doing this. We all know that we have to pay tax on our net profits. Imagine that you have a capital gains or profits on swing trading for around 1 lakh, right? So in the whole financial year that has passed, you have made a profit of around 1 lakh. You'll be liable to pay a 15% tax on this 1 lakh profit because it is considered as short-term capital gains. You remember, right? We just discussed it. Swing trading is considered as short-term capital gains and it is taxed at 15%. So on this 1 lakh profit, you're paying 15% tax. That means you're paying rupees 15,000 tax to the government for your profits. Now one thing that we all have in common probably right now is that the markets have fallen recently and a lot of stocks in our portfolio or our holdings are probably in losses. So what if you book those losses currently? Just hear me out. I know probably a lot of you do not like to book losses because of many psychological reasons, but hear me out right now. So here, imagine you have a loss of around 1 lakh in your current holdings, okay? So you have made a profit of 1 lakh in the last 12 months, but currently you have a loss of around 1 lakh in your holdings. So if you book the losses currently, what will be your net profit for the financial year? It will be 0, right? So how much will you have to pay to the government? You will have to pay 0 rupees as taxes to the government. So how it works is that now you have sold your shares in your holdings and now your net profit for the financial year is 0, right? You can buy these stocks back tomorrow itself. There might be a slight difference, but it's okay. You can buy these shares back tomorrow itself and your net tax bill for the year will be 0 and you will still be holding all your favorite shares in your holdings. And if your net financial year goes to a loss, it is only psychological, right? Because you can show it as a short-term capital loss and you can carry forward this loss for the next 8 years. What we discuss right now is how to reduce your short-term capital gains liability or to reduce your swing trading profits liability. Now let's discuss about reducing your futures and options liability. Futures and options profit or loss is considered as business income by the government. So imagine that you have around a 1 lakh rupee loss in your futures and options trade, and you have around a 1 lakh rupees profit in any other business. So normally you would have to pay taxes on this business income, right? But since you have a loss of around 1 lakh in your futures and option trades, you can set both of these together off and you can have a tax bill of around 0 rupees. But please do note that you cannot do the same for salary income. This needs to be a different business income for you to be able to do this. So now let's discuss how you can tax loss harvest on your futures and options profits. So imagine that you have around a 1 lakh rupee profit for the financial year and you are currently holding a Nifty future for around 50,000 rupees loss. So for this 10,000 or sorry, for this 1 lakh rupee profit that you have for the year, you are liable to pay a tax of around your income tax slab. So let's imagine your income tax slab is around 30% or your tax liability is around 30%. So on this 1 lakh profit that you have here in your futures and options trades, you would be liable to pay around 30,000 rupees as taxes to the government. So imagine you have it here, right? A Nifty future position that is running a loss for you. So what you can do is you can book, imagine right now we are in March, right? So you can book the loss in this Nifty March future and roll it over. You can buy a Nifty May future or a Nifty April future, and in a similar way you can book your tax loss harvesting for futures and options trades. Now the next thing that we have to discuss is tax harvesting. No, this is not the same as tax loss harvesting. This is something totally different. So the concept of tax harvesting is where we make use of the rupees 1 lakh deduction that we have on long-term capital gains, right? We discussed this earlier. You can go back to this part to make it clear what is your tax bill on long-term capital gains, short-term capital gains and futures and options trade. You can go to this timestamp to make clear of all these things. The trick here is that if your long-term capital gain for the financial year is under 1 lakh rupees, you do not have to pay any tax. So the idea here is that you will be booking your long-term profits each and every year, so that every year you try to keep your tax bill under or your long-term capital gain profit under rupees 1 lakh. So let's discuss it with an example here. So imagine you have made a lot of investments right now for which you will be booking profits after 10 years. So after 10 years, let's imagine you have a profit of rupees 10 lakh. So with the current rules, you'll have to pay a tax of around 10%, that is 10% of 10 lakh, that is 1 lakh rupees as long-term capital gains after your 10th year. If you do tax harvesting right now, if you manage to keep your every year profits under 1 lakh each, you do not have to pay any tax. So instead of that 1 lakh rupees at the end of the 10th year, you'll probably pay next to 0 rupees at the end of the 10th year. Again, for long-term capital gains, it is fine if you make a loss for this financial year, because even if you make a loss, you can set off these losses for another 8 years. So it is totally okay to book a loss currently and buy back those shares tomorrow for a minimal difference, so that you can make use of this rupees 1 lakh deduction. So I hope the concept is really clear, because in tax harvesting and tax loss harvesting, you're booking your losses currently that you have, so that your total financial year tax burden goes down. Now the last concept that we are going to discuss about 80C deduction on your income tax. That is, you can invest in all these assets, but the one that we are going to discuss right now is equity linked savings schemes or ELSS. So unfortunately, the last date to buy these tax saving mutual funds is around 28th of March, and probably this video won't be out by that time. So under section 80C, you can claim an income tax deduction of around rupees 1.5 lakh for the whole financial year. This is including all your investments in ELSS and all these different assets. Let's just talk about ELSS right now. If you invest in ELSS, that is tax saving mutual funds which mainly invest in the equity market, you're probably going to get around 12 to 15% compounded annual growth. You'll have a standard lock-in of around 3 years. So the great thing here is that you have a deduction of around rupees 1.5 lakhs. So if you're a salaried individual, you can reduce your tax slab by this, because you can invest rupees 1.5 lakh in ELSS and reduce your taxes. So if you are on the highest tax slab, you can save up to 46,800 rupees by doing this. So I hope you enjoyed the video. We have mainly discussed 3 points here: tax loss harvesting, tax harvesting, and ATC section of the ITR. This is all actionable content that you can do before this financial year ends. That means before 31st of March, to reduce your tax burden for the year. So if you like this video, you know the drill. Like, share and subscribe to our channel. This is Ajay signing off. See you in another video.